So the second part of this question says, evaluate the risks of material misstatement, which is basically the risk that the management have got it wrong. We're not saying they have, we're just saying it's a risk that they might have got it wrong. And so we can go look at it, and we're going to decide this while we're doing the planning. And again, it's of the individual and of the group. So let's go and have a look. First of all, it says the most significant event was the acquisition of Canary, which took place on the 1st of February. They purchased all of Canary's shares, so 100%, for 125 million and contingent consideration of 30. Now, the one that they'll maybe get wrong on this is the contingent consideration, isn't it? So if you remember, so number one would be the contingent consideration. You say that that should be measured at fair value. Okay, we need to make sure it's measured at fair value, and it should be discounted because it's not going to be paid for another 3 years, I think. So, yeah, it will be paid on the 3rd anniversary if the revenue grows by 8%. They engaged an external provider to perform some due diligence on Canary, whose report indicated the fair value of the net assets was 110 million. So the second point is, well, that might be wrong. We're not saying it is, but the fair value of net assets is always a risky area, so things like, does it include all contingent assets, contingent liabilities, intangible assets, but it's less risky because they have had an external person in, an external expert who did some due diligence, so it's less of a risk for us. Then he says Goodwill is calculated at this, and look at that, the 30 is put in full, so you say should be discounted. It hasn't been, so we definitely need to focus on that. They seem to have got that wrong. Keep going then. To help finance the acquisition, they issued loan stock, raising cash of 100, so they got 100 loan, no problem there. 5-year term, no problem there. Repaid at the end with a premium of 20 million, so they're paying back 120. That 20 is an extra form of interest. So what we would be worried about is the treatment of that premium. It should be spread across the loan, like you do when you're doing amortised cost, and it's done using the effective interest rate. Remember all of these points. I want a couple of sentences. Okay, we'd be worried then that they would put the premium in, so the risk is that they'd put the premium at the end, and if they did that, they would be understating their liabilities and their interest expense. And similarly over here, thinking about it, if they've got this contingent consideration wrong, they are overstating goodwill. Another point about goodwill, thinking about it, is goodwill should be impaired. There was no sign of impairment. There should be an impairment test annually. No sign of one. They might have done one, but if they haven't, then again, it would be the overstatement that we'd be worried about of goodwill. Keep going, loads to say, a couple of sentences on each. Canary then, manufacture pottery figurines and ornaments. It's a good strategic fit. Its acquisition will enable the group to diversify into a different market. Maybe that's a bit of a risk already, but material misstatement, maybe not, maybe more of a business risk. Approximately 30% of the sales are made online, and it's hoped that online could come into the rest of the group. So online sales, the issue here would be revenue recognition. It might be difficult to decide when to recognise. It might be difficult, might be quite a complex system. Do we need to use CATs to do it, that sort of thing? They've only ever operated as a single company. It's the first time they've been part of a group company. So there's a risk that they haven't highlighted transactions with the group, because we need to know about the transactions and the balances with the group, because they will be related parties in their own statements. which reminds me of something else, and they will be cancelled in the group statements. And talking about their own statements, because I was getting carried away with myself thinking of the group, on their own statements, remember all this as well, not only, if they've put this in, not only will they be overstating goodwill, in their own accounts, they will be overstating the cost of investment in the individual accounts. Anyway, we're on our way. I think, how many marks was this? 18, so we're on our way. We're on to point 7, hopefully, somewhere. Yep. Financial performance of the group. I will let you do that yourselves, okay? Remember to take out the subsidiary when you're doing some analytical procedures, but definitely some analytical procedures in there. But I want to concentrate on some other points. They received a grant of 35 million, and it's for the redevelopment of its main manufacturing site. So again, we want to ensure that the grant is treated correctly, and that means it's treated as a capital grant. And if you remember, a capital grant, what happens is you credit the asset or you credit the deferred income, and then that means if you credit deferred income, you will spread the income, you spread the grant effectively over the grant term. Our worry is that they're not spreading it over the grant term. Our worry is that they show it immediately, show the income immediately, like it was a revenue grant. And if they did that, then we would be again overstating income. So, we're getting lots of marks here, aren't we? The government is providing grants to companies for capital expenditure on environmentally friendly assets. They've spent 25 million on solar panels. That sounds good. That's environmentally friendly. And intends to spend the 10 million on upgrading its production and packaging line. So the other 10 million, that's just for upgrading. It's not for environmentally friendly. So the 10 million, is this right? Does it meet the criteria? Because if it doesn't meet the criteria for the grant, then what we've got to go and do is provide for a refund. And if we haven't, then again, we are understating liabilities. Have you noticed these are all going one way? Understating liabilities, overstating assets, etc. Remember, look, what I'm doing, I'm just letting the scenario lead me. A new IT system was introduced during the year to Crow and to Starling. That's got to be a risk of material misstatement. New IT system. We need to check it's working properly. Check the balances going into it. Again, possible use of CATs. What else? Yeah, because it does financial reporting control, so you put that in, it's over financing. And it says, unfortunately, the director left the company last week. So the finance director left the company. So that's going to be a risk of material misstatement. Replaced. Who are we going to ask for information? Where we get information about the previous period from? Okay. So overall then, risks of material misstatement. We've got 11. There would have been a couple more in the analytical procedures, and we were making good, strong points as well. That's how you go and get that. Obviously, try and split it up as well between the group and the individual accounts as much as you possibly can. Now let's have a look at recommending then some principal audit procedures for goodwill. Let's see if we can come up with 5. So, principal audit procedures for goodwill. Remember the way we do it when we see audit procedures, we think of AEIOU, we think of what are we working on or who, and we say why. If you don't do this, you'll not get the full marks. So I think first one, recalculate goodwill, can't we? Recalculate the goodwill working to check its accuracy. And then if you think of the goodwill working, we were worried about the contingent consideration. So we would inspect the terms of the agreement to verify the 8% revenue increase amount. Then we'd have to discuss with management why no discounting, why the full 30, surely it's not definite. Then we might want to inspect to see if we will get the full 30, if we do have to pay the full 30, inspect forecasts on management accounts to see if the 8% was met so far. That will give us an idea. Discuss with management, we said about, has there been an impairment review? So we've already got it there. We'd also want to inspect the due diligence report for the value of the net assets in the goodwill working and also the assumptions behind it. There's plenty more that you could have come up with. Remember, in the exam, don't write it out like that. Put these as full sentences, but it just makes sure that you get